or some weird implication.
Do it. Just leave it.
Come on.
Is it rolling?
No, it is.
Live from the McNeil International Studios in beautiful Baja, Tustin, Professor Mark McNeil from Irvine Valley College.
Wait. What's this? And wait a minute. What happened to you? Something awful has happened. Out of here. Out. Stop stealing the props. All right, this is the second in the series. It's about money creation banks in the Federal Reserve. This is a meaty one. Bear with me, please. It turns out the original modern-style banks came from the Italian city-states, Florence, Genoa, Venice, etc. And my mother's Italian, my family's Italian. So I was digging through the archives and I found this old dusty notebook, and in it was the notebook of my great 14 greats Uncle Luigi. And it turns out he was a banker in Italy, Naples. Are you interested in hearing his story? What?
Yes.
Okay, well, I'm glad. All right. Well, it turns out that Luigi was not a banker. He didn't start out a banker. He started out a goldsmith. He worked with gold and made things out of gold, and he had a shop. And the drawings are in the archives, of course. He had a strong area where he kept his gold, then he had a work area, and then he had a front place where people would go in. Now, the gold area had to be very strong to protect the gold from thieves and brigands and so forth. The other thing about Luigi was that Luigi was the most trusted person in the town. His word was his bond. If he ever said anything, he would do it, etc. So people who had gold, gold was money then and it would trade. People who had gold would go to Luigi and say, Luigi, would you please hold my gold for me, please? I don't have any place in my house to hold it. And Luigi would say, sure, no problem, huh? You give me the gold. And the other guy would say, Luigi, I know you and love you and trust you like a brother, but would you mind giving me a receipt for it? So Luigi would make up a little receipt. He'd make up a little receipt. And the receipt would say, I, Luigi, promise to give you 1 unit of gold if you present to me with this receipt. And so people would come and bring the gold to Luigi, and Luigi would have, he had his own gold here, but that's not part of our story particularly. What would happen is he would store the gold for people in the town. So let's say he has 10 units of gold in his vault here that other people are storing with him, and he has 10 receipts outstanding. Now, the liabilities to Luigi are the receipts, and the assets are the gold in the vault. And sure enough, people would come and bring him gold and take a receipt, and other times they'd bring receipts and take the gold, and the amount of gold would fluctuate up and down. But it kind of averaged about 10. Sometimes it would go all the way down to 6. Sometimes it would be up to 15. But he always had gold. And he always, every time anybody gave him a receipt, then he would cough up the gold. And then something happened. And according to the family archives, it was the brother-in-law. It's always the brother-in-law. It was a dark and stormy night. And he got a knock on his back door, and it was the brother-in-law, dripping wet and begging, Luigi, you got to do me this favor. You got to give me gold. And Luigi says, I don't have any gold. And the brother-in-law says, you have a storehouse full of it. And Luigi says, please, that's not my gold. That's the money that's the gold that I hold, and people trust me. And the brother-in-law says, excuse me, Luigi, give me 2 units of gold, or your sister starves. What could Luigi do? So Luigi gives him 2 units of gold. And the brother-in-law swears, in 3 months he'll have it back. Swear on da-da-da. Okay, 3 months later, Luigi's banging on the brother-in-law's door to get the money back, and gets the money back. And is anybody the wiser for the fact that some of these people's gold was missing? And the answer is no. So now, the brother-in-law, of course, cannot keep his mouth shut. And so, word starts spreading that if you go to the back door of Luigi on a dark and stormy night and tell him a sad enough story, he might lend you some money. And sure enough, Luigi's getting these people banging on his back door saying, please, Luigi, you'll save my life. And I swear I'll give it back to you in a month and a half. And if you'll do me this favor, I'll give you the money back, plus a little something extra. Luigi liked the little something extra part. So Luigi would have like 10 receipts outstanding, and then, against these 10 units of gold in his vault. But then something happened. What happened was the receipts started circulating as money. Farmer A wanted to buy a cow from Farmer B. Farmer A has a receipt, and so Farmer A takes the receipt to Farmer B and gets the cow. And takes the receipt, and now Farmer B has the receipt. Well, to get the receipt, that's what happened, because Farmer A could go to Luigi's place, get his gold, and then come back and give it to Farmer B. But then what would Farmer B do with the gold? Take it to Luigi and get a receipt for it. So finally, Farmer B says, just give me the receipt. We trust Luigi. So now you have these receipts circulating, and this is the basis or beginning of what we call fiduciary money. The word fiduciary means based on trust or faithfulness. So fiduciary money. These receipts have no intrinsic value, but the value is that they're accepted because of people's faith in Luigi. So Luigi does this, and things are going good. And, he sneaks out. At any given time, he's got 10 receipts out from people who gave him the gold. But he doesn't lend the gold anymore. He just writes a receipt and gives it to him and says, here, you can spend this. And anybody who gets the receipt, they can't tell if this is one of the ones that Luigi wrote out by lending or whether it was the one that came from the gold. Because they're circulating, nobody knows, nobody really cares, as long as they believe that when they hand Luigi a receipt, they will get a unit of gold. And that always happens, and that's why people accept it. So, now, instead of lending the gold, Luigi just writes out a receipt, boom. And at any given time, Luigi's got 10 units of these lending receipts out, as well as the 10 based on the gold. And then, the wife gets pregnant. He's got costs. Has another kid. Needs to add on to his house. His nerves are getting to him. He needs a jacuzzi. He loses a little money in Vegas. Needs a new Lincoln. I don't know. 1, 2, 3, 4, 5, 6, 7, 8, 9. And then something else. Anyway, he's got 100 receipts outstanding. And 10 units of gold to back them. Is Luigi in trouble? Is this ever going to work? If you knew what was going on, would you give your gold to Luigi in exchange for a receipt? Would you deposit your gold with Luigi? No. Is it safe? Is it going to blow up? Do you deposit money in a bank? Yes, you do. And this is your bank. This is what is called a fractional reserve banking system, where a fraction of the outstanding liabilities, in this case 100 receipts, is held as a reserve. In this case, the fraction is 10% reserve. That's a 10-to-1 ratio. So for every one of the units of gold, Luigi lends out 10 receipts. And the ones he lends out, he gets interest on. That's why he does it. That's a bank now. Fractional reserve banking system and fiduciary money. Now, what's the money supply? And the answer is the money supply is the money that is held by the non-bank public. So this money here, these receipts, 100 of them, that are circulating and they are accepted, that's the money supply. What about these 10 units of gold? They're not part of the money supply because they're not held by the non-bank public. They're held by banks for a reserve, so they're not part of the money supply. The reserves are this amount, the money supply is 100. Then, something happens. Something always happens. And Luigi's dressed in his three-piece banker suit. He's clickety-clacking down the cobblestone streets in his town, and he rounds a corner, and in front of the bank is a long line of people, each holding a reserve. Does Luigi know he's in trouble?
Now he does.
He does now. He goes up and he says, "Oh, there's no problem here, people. You know you can always get your money from me. I've never failed at it." What's he trying to do? Get them to go home. But they don't for some reason. So the first one comes up with a receipt. Comes up with a receipt and says, "Luigi, I'm sorry, but my sister in Schenectady is sick. I got to have the gold. I'm sorry." So Luigi that person turns in a receipt. There are now, first of all, you agree the money supply is currently 100. But now Luigi gives out that 1 unit of gold, 1 unit of gold in exchange for a receipt. So there's 99 receipts now in 1 unit of gold. What's the money supply? And the answer is gold is money, and the receipts are money, so the total is 100. 99 plus 1. And then the next one turns in their receipt, and now there's 2 units of gold outstanding, and there's 98 receipts. And the next one, the next one, the next one. And then pretty soon, there are 90 receipts outstanding. 10 have been turned in, and 10 units of gold circulating. What's the money supply? 100 still. Now the next person to turn in one of those receipts, Luigi says, "I'm sorry, I have no more money." What happens to the money supply?
Drops by 90.
Are any of these 90 receipts money anymore? And the answer is no, because the first characteristic of money is that it must be accepted. Will these be accepted when they know that Luigi won't cough up gold for them? The answer is no. So, did this happen during the Great Depression? The answer is yes. 30% of the, roughly, 35% of the banks folded. 32% of the money supply disappeared, vaporized. And if 32% of the money supply disappears, would spending fall? Would aggregate demand decrease? Would that send the economy into a recession? Absolutely. Okay. So we now have poor old Luigi gone belly up. But we want this story to have a happy ending. And so, well, let me just do it. What happens is the government passes a law, and they come in and they reopen the second bank of Luigi, and they put FDIC in the window. What does FDIC stand for? F is federal, D is deposit, I is insurance, corporation. That insures the deposits of these people up to $250,000 now. And what's the purpose of it? To try and keep people from being nervous about getting their money and going to the bank all at one time and crashing the bank. But in addition to that, they created the Federal Reserve System, which is the third national bank. It's the third central bank. It was created by the Federal Reserve Act of 1913. The first one was from 1791 to 1811. The second one was from 1812 to 1832. Andrew Jackson blew that one up. This one blew up in the dispute between the Hamiltonians and the Jeffersonians. And between 1832 and 1913, we had no central bank. We were a giant country in the world by then, and we had no central bank as of 1912 at least. And so the Congress created the Federal Reserve Act, which created the Federal Reserve System. And it's a central bank. The Federal Reserve is the central bank. The central bank has 4 functions. The first is the Federal Reserve is a bank to the government. So if you get your tax return checks, you get a check from the government, and that check is drawn on the Federal Reserve System. The second is the Federal Reserve is a bank to banks. Just like I keep my money with my bank keeps their money with the Federal Reserve, on account with the Federal Reserve. Third function of money is to regulate commercial banks. They send auditors in to make sure that they're abiding by the reserve requirements and the law, and they're not too risky and all that stuff. And finally, the central bank conducts monetary policy. We will talk about monetary policy soon. The structure of the Fed is odd and interesting. The structure of the Fed is controlled by a 7-member board of governors. And each of these 7 members has a 12-year term. And each of these terms expires every 2 years. One of these guys' term expires. And the purpose of this is to isolate and insulate the people who control the money supply from political pressures. So in one term, a president can get 2 of these board guys because it's 4 years. in a 2 terms, 8 years, a president can get 4 of these guys, but then he's out of office, or she's out of office. So then there are 12 regional banks. And this was to deal with the regionalism that caused the second Bank of the United States to blow up. The western part of the United States wanted go, bang, bang, lots of money, lubricate the wheels of commerce. They wanted the money to flow. They wanted lots of it. The New England states were manufacturing. They wanted sound money, and the western guys thought that the New England guys were trying to restrict the money supply and choke off their growth. The southern section, the southern part of the United States, wanted free trade, and the New England was manufacturing. They didn't want competition from other sources, so they wanted protection, whereas the South wanted free trade. So this regionalism became an issue with the second Bank of the United States, and it blew it up to some extent. So when they created the third Bank of the United States, they created 12 regional banks. And supposedly each region was supposed to take care of its area's needs. So on every bill you can see there's a letter. So this one is G, I forget which letter of the alphabet it is, but this is the Chicago Regional Bank. L is the 12th letter of the alphabet, and that's the San Francisco Regional Bank. That's the one we're in currently. There's one in Boston, St. Louis, Philadelphia, Minnesota. So as you spend your money, you can collect all 12 and become cognizant of the structure of the Fed. 12 regional banks. Each of these regional banks has a corny bank president. I went to the San Francisco Fed and I heard a talk from John Williams, who is the current head of that regional bank. But the monetary policy organization of the Federal Reserve is called the FOMC, the Federal Reserve Open Market Committee. Federal Reserve Open Market Committee. And each of the 12 regional bank members goes and debates monetary policy, but so does each of these 7 Board of Governors who are stationed in Washington, D.C. So there are 19 members of the FOMC sitting around the table, but only 12 of them get to vote. Why? Well, all 7 of the Board of Governors members vote every time, but then only 5 of these regional bank president guys get to vote. Why? Because they want the power of the Federal Reserve to be in the Board of Governors, who are appointed by the president and confirmed by the Senate. So these guys are supposed to represent the people, whereas these regional bank president guys, they are nominated by the local banks and confirmed by the Board of Governors. So, they just wanted to make sure that the majority of people voting for monetary policy, had the public interest in mind. Yes, you have a question?
Then how do they decide the 5 regional banks to bring to vote?
Oh, they rotate. Some of them this year, some next year, some of them next year. And the New York Fed always gets it because the New York is spoiled. Oh, they're special. Anyway, I don't know why. They're the biggest one. Real monetary policy gets done out of New York. Now, I have a dream. I want to be one of these guys. Yes? If you guys ever get any kind of political power, remember, I want to be on the FOMC. I don't want to be one of those guys. They have to work and they have to put up with people and be nice to them. I hate that. One of these 7 guys is the chair. The current chair is... Well, I'm not going to be yelling about that, but the chair is one of these 7 members, but has a 4-year gig as the chair. They can be reappointed again and again, but they get 14 years, and that's it. They're out, more or less. There are exceptions. I don't want to be this chair because the fate of the world hangs in the balance with that person. And I don't want to be the vice chair either, because at any given moment I would be I'd be a heartbeat away from the chair's seat. I don't want that would be too nerve-wracking for me. I want to be one of these. There are 5 of them left over here. I want to be one of those guys. Total slackers, just go in and argue with people. I'd love that. Make that happen. Powers of the Fed. Federal Reserve has monetary powers. They can set the reserve requirement, they can set the discount rate, and they conduct open market operations. So, you know, the reserve requirement that I showed you before was a 10-to-1 ratio, yes? And what that meant was that for every 1 unit of reserves that the bank had, they could lend, that the banking system has, then the banking system can lend 10. Well, this is a 10% reserve. And if that's what the law is, then if there are 10 units of reserves, then the money supply can be 100 because it's a 10-to-1 ratio. But what if the Federal Reserve were to make the reserve requirement not 10% but 20%? Well, if the reserve requirement is 20%, this is a 5-to-1 ratio, which means that every one of these dollars of reserves can only support 5 lent out dollars. So with $10 of reserves in the banking system, the money supply at most can be 50. Do you understand why? Because now at a 20% reserve requirement, each one of these reserve dollars will only support $5 worth of these checkable deposit loan things. So if the reserve requirement goes up from 10 to 20%, then the money supply has to go down from 100 units to 50 units. Okay? What if the Federal Reserve, instead of raising the reserve requirement, makes it 5%? Well, 5% is a 20-to-1 ratio. So every unit of reserves can support $20 outstanding, and if there are $10 of reserves in the banking system, and each of these can support $20, then the money supply can be $200. So when the money supply when the reserve requirement changes from 10%, that's a 10-to-1 ratio, to 5%, that's a 20-to-1 ratio, the money supply will rise from 100 to 200. So when the reserve requirement goes down, the money supply will go up. That's the first power of the Fed, and it's almost never used. It's never used. It's 10% for the most part, and that's it. And there are other circumstances, but generally speaking. Then the discount rate is the rate at which the Fed lends reserves to banks. Banks can take their assets, their notes, and to the Fed and get loans, and they get charged interest. That's the discount rate. If the discount rate is 5%, then they get $100 worth of notes. They only get $95 in reserves. But the point is that they can get reserves from the discount window at the Fed, and when they do that, what it does is it increases the amount of reserves in the banking system. And so if some bank goes and gets an additional unit of reserves, if the reserve requirement is 10%, these 10 units of reserves will allow the money supply to be 100 units. But if somebody goes and borrows reserves and there's 11 units of reserves, but the reserve requirement is still 10%, then the money supply can grow to 110 because each of these 11 units of reserves can support $10. So when there are more reserves, if it comes from the discount window, then when the discount rate goes down, banks are encouraged to borrow reserves from the Fed, and they have more reserves, the money supply goes up. But if the discount rate goes up, that means banks have to pay more to get those reserves from the Fed. They will buy less of them, and they'll turn their reserves in or something, and as a result, the money supply will go down. So that's the second power of the Fed, changing the discount rate. And the discount rate does almost nothing. It has almost no effect, because in the real world, banks don't borrow. When they need reserves, banks don't borrow those reserves from the Fed. They borrow them from other banks. So banks that have excess reserves at the close of business, they call those funds into the federal funds market, and then some other bank is short reserves and they need to borrow them. So one bank borrows excess reserves from another bank, and then the federal funds rate is the price of those funds. As long as I'm at it, I have to tell you the prime rate is the third rate that you should probably know about. And the prime rate is the rate at which banks lend to their most credit-worthy customers. Who's the most credit-worthy customer you can think of to a bank? Not you. Bill Gates, maybe. Anyway, it's the rate at which Bill Gates borrows. It's the most credit-worthy customer. So you should be able to distinguish between the discount rate, which is the Federal Reserve Bank's monetary policy rate. This is the federal funds rate. This one is very important in the real world. And then the prime rate. A lot of people have variable rate credit cards, and it's like prime plus 4, or prime plus 6, and the prime is set every month or so. All right, those are the first two powers of it. This one, the open market operations power, is the one that the Federal Reserve does every banking day. They're in the open market buying and selling U.S. government securities. Remember, it's all about the amount of reserves that exist in the system, and the money supply will expand or contract based on that. And this open market is the means by which the Federal Reserve puts new reserves into the banking system or takes them out. When the Federal Reserve puts new reserves into the banking system, the money supply will grow because it's got the reserves to grow. When the Federal Reserve pulls reserves out of the banking system, then it causes the money supply to shrink. So how does it do it? Well, it's fairly straightforward. Every business day, first of all, there are $19 trillion worth of these U.S. government securities because the securities come from the U.S. federal government debt. There's a primary market. That's the one where the federal government sells the securities to people and then gets the money and then uses it for its operations. But then there's a secondary market where people who have these treasuries and they want to get rid of them, they can sell them in the open market to people who just want to buy them. And so it doesn't have anything to do with the government. It's just a sale, a swap of assets, money for these treasuries. So if I go in to the open market and I buy a $100,000 U.S. government security, you give me your security and I give you $100,000. There is no effect on GDP, there's no effect on the money supply, simply a swap of assets between people. But if I am the Federal Reserve and I go buy a U.S. government security from you, I take your security and I write you a check, $100,000 drawn on the Federal Reserve Bank. You take that check to your bank and you deposit it, and the bank sends the check to me, the Federal Reserve, to clear. And I take from my golden account that never has to be balanced, I go and I put $100,000 into that bank's reserve account. There are now more reserves in the system. So when the Federal Reserve buys a U.S. government security, it is taking securities out of the economy and putting into the banking system new reserves that didn't exist before. When the Federal Reserve sells a U.S. government security, and they have hundreds of billions of dollars sitting on their shelves of these U.S. government securities, when they sell it, then they are putting a piece of paper with a picture of an eagle on it, that's a security, into the economy and pulling out money. This is money that's coming out of banks. The bank reserves decrease and the money supply has to shrink because of this. So when the Federal Reserve buys U.S. government securities, puts more reserves in the system, and the money supply can grow. When the Federal Reserve sells U.S. government securities, it's pulling reserves out of the banking system, and the money supply has to decrease as a result of this. That's the Federal Reserve, the structure of the Fed. That's how money is created. And that's the second money video. That's it. Say goodbye. I mean, wake up and say goodbye. There we go.